Shwetank, my first question to you is with regards to your revenue per available room. That growth largely this quarter has come in from your average room rate increase, but occupancy has seen a slight dipping. Do you expect this trend to continue?
So whichever way you look at, the macros are very heavily in favor of the industry, and also the general macros of the country are brilliant. So what is happening essentially is that growth is coming from all quarters. Not only is the free individual traveler traveling more because as travel and tourism becomes less discretionary and more a way of life, that means more shorter trips, longer weekends, etc., and therefore occupancy is being boosted across the country in most leisure destinations. The fact that there's an improvement in infrastructure overall, and the recently concluded budget, we saw a 12 lakh crore investment coming into infrastructure, so that should further boost the infrastructure and therefore add to this trend. So that's helpful as well. If we look at the corporate earnings throughout the country, in general, the corporate earnings are an upward trend, and there is a direct correlation between corporate earnings and MICE travel. So that's on the upward trend as well. And socials in India will never go out of fashion. So the big fat Indian wedding stays where it is. So overall, this trend is set to continue. The recent, of course, the clearing up of the trade wars is also very helpful. Because that would mean more international traveler coming through. And India being such a strong economy, India is being discussed in most boardrooms of companies of any significance. Therefore, that should be a positive overall. So hence, we don't see any slowdown in the trends, and we expect the industry to continue to year on year. And the final fact that is very helpful is that the supply is still behind the demand. And therefore, that gap arbitrage is also helpful.
Okay, got it. Shwetank, with regards to your non-MMR markets, they've seen a good growth of 25%. Again, here it was largely led by our ARR increase, but and this growth is largely led by Bangalore as well as Hyderabad and Pune. Do you see a structural shift here?
No, so MMR has been our mainstay for a long time, and it continues to be a very important part of our portfolio. What's been interesting to note is that we have, for this particular quarter, beaten the larger MMR market quite significantly, and also outperformed most of our competitors in our comp set, despite the market being very challenging, and we having our own challenges with construction going on, especially at Powai. So that's been very interesting to note. The larger MMR region, the beyond the MMR region, what's contributing to the portfolio is also very interesting to note, because it's always been a part of our larger strategy to diversify both geographically as well as between leisure and business segments. So that was a conscious call that the company had taken, and that's beginning to bear its fruit. The south of the country has been very strong for the market as well as for us, and that's coming through. But most importantly, even our leisure destinations are starting to sort of kick up the performance to where it was expected to be. And with Athiva, especially in Khandala, stabilizing, and the additional 130 rooms stabilizing in Bangalore, we expect this growth trend to continue, and for regions beyond MMR to contribute significantly to our portfolio.
Got it. So Shwetank, then as inventory additions accelerate for you, will strategy tilt more towards protecting your occupancy, or will it be towards maximizing your ARR?
So look, this is a difficult question to answer, because typically these trends tend to be in direct correlation to the market that you are in, and more specifically the micro market that you are in. So the market is what dictates this. But at the end of the day, we have to be cognizant that it is the RevPAR that drives revenue, which is a multiplier of occupancy and ADR. And we normally tend to reflect the market, but outbeat the market on that particular metric. Case in point being Bangalore today. If you see, our ADR growth is upward of 25-27%, whereas the rest of the market would be around 18-20%. So that's where we have taken an ADR strategy. But some of our resorts have still not stabilized, and the occupancies are below what we expect them to be. And if one of our resorts is today in the late 40s and we expect it to stabilize at 60-65%, then we will take occupancy route there, even if it comes at a cost of a slower ADR growth. Because at the end of the day, RevPAR drives revenue.